Hi, thanks for joining me. Buffers are all the rage. The story is really fantastic. They cover the first 15 or whatever percent down in exchange for the same cap on the upside. It's easy to understand and sounds so appealing that many people don't look deeper to see some of the challenges with these instruments. But that seems to be changing. One chief investment officer that we know is moving tens of millions of dollars out of buffers because of the hassles of ownership and cracks below the surface of that narrative. To start, one only gets the full benefit of ownership if it's purchased at inception and held to the end of the period. But that's not always awesome either. This year's a good example. Let's say you bought January 2023 15% S&P buffer with the matching 15% cap. In July, you hit the cap with 5 months to go in a volatile year. Do you roll fearing that you're now at 15%, there's no more upside potential, and you have 15% to fall before you hit the buffer, or just let it roll? Also, one has to monitor that for every month or every client. Another overlooked factor is that most buffer funds provide capped returns based on price rather than the total return of the index they're tracking. If it's the S&P, as it commonly is, that long-term average yield is about 1.8%. Then there's the expense ratio of the ETF, which averages about 82 basis points. So the real cap on the buffer is only about 12.5%, and that's before advisor fees. Potentially the most impactful challenge for buffer ETFs is big market drops. If stocks fall well below the buffer level, and then the ETF rolls with a new cap, investors can suffer and then lock in those losses. As a result, many buffer indices show returns similar to that of inflation. So, what's the point? Our managed risk strategy addresses many of these issues I discussed, with the goal of attempting to track and produce stock market, not just inflation gains. Thanks very much. Take care.